Hey guys, it's Patrick. You may have heard of private equity, but have you heard of private credit? It's a nearly $2 trillion industry that I don't see a lot of information about, but I find really interesting. Today we are going to break it down and talk about how it works and any risk it may pose to the market. Let's dive in. We've all heard of stocks. Stocks are a form of public equity, equity being ownership in a company. It's public because relatively anyone can invest in companies by purchasing stock in a stock exchange, like the New York Stock Exchange. Private equity, on the other hand, involves the buying of private companies. This is not done by the general public. In contrast, public credit is debt purchased on the public market. This debt can be a mortgage-backed security or other types of corporate bonds. And you may have guessed that private credit then would involve the lending of companies in the private market, not accessible to the general public. And you'd be right. The most common form private credit takes is direct lending. This is pretty self-explanatory. It means a private, non-bank lender gives money to a private company. Because non-bank lenders are not banks, they have fewer regulatory requirements. Therefore, there is a greater speed and certainty of execution, and borrowers can directly negotiate terms with the lender, hence direct lending. Private companies tend to pay a premium for the speed, agility, certainty, and customization for this type of credit. Now that we know a little bit about what private credit is, let's talk about how it came about. After the 2008 financial crisis, many banks stepped back from the types of loans they were originating and the amount of loans that they originated. They gave fewer loans to riskier companies, for example. This generally caused a lack of credit available to private companies. Further, regulations such as Dodd-Frank made it more difficult for banks to increase the amount of lending they were doing. Private credit developed to fill a void left by banks. How much of the market is covered by private credit? In 2023, assets under management for private credit reached $1.7 trillion. And in 2027, it's expected to be over $2 trillion. Private credit has also generated historically good returns for investors. This relatively high return compensates for the increased level of risk because they cannot sell loans on the secondary market. This goes back to the private versus public options we talked about earlier. This means that they have to keep the loans on their books. If the loan defaults, the non-bank lender loses. So now that we know a little bit about how private credit developed and why it's favored by borrowers and investors, let's take a little bit of time to talk about the mechanics of these instruments. Private credit is funded from institutional investors. These investors are pension funds, hedge funds, other private equity firms, family office, or high net worth individuals with assets over $5 million. These investors choose private credit because they are looking for a certain return profile and to diversify their investments. Remember that equities, which are stocks, usually have higher risk and therefore higher return than debt, which has a lower risk and generally a lower return. You can get higher returns by increasing the amount of leverage, which means you're increasing the amount of debt. This also increases risk. Fundamentally, it's a trade-off between risk and reward. Private credit can somewhat be in the middle of equity and debt since they are unique debt instruments that are riskier than traditional debt, but still less risky than equities. You may be thinking that, okay, so a private credit fund takes out some money from investors and lends it out. Seems simple enough. Well, that is actually not completely the case. See, that wouldn't actually generate high enough returns for the investors or for the credit fund itself by lending a loan. So what does private credit do? Remember what increases return? Leverage. That's right. So private credit gets leverage on the loans it gives out. It gets loans on the loans. Crazy, right? The first mechanism we'll talk about is warehouse lines. Warehouse lines are lines of credit offered by a bank to a non-bank lender. The credit offered by the bank is collateralized by the loans the non-bank lender makes. For example, if the non-bank lender originated $1 billion in loans on commercial real estate, the bank would allow a line of credit of $600 million. This is not to be confused with the collateral of the original loans themselves. The original loans may be collateralized by the real estate and may have represented a total value of $1.4 billion of real estate. But the non-bank lender only wrote $1 billion worth of loans, of which the bank lending to the non-bank lender only writes $600 million of credit on these loans. As you can imagine, this calculation is operationally intensive for banks. So only a couple of banks offer these services, such as Wells Fargo. Private credit loves this because it means that of $1 billion of loan it originates, it only has to use $400 million of its own money. The rest of the $600 million can be from a bank at a fixed interest rate that is lower than the rate of the original loan. This means that private credit earns a spread on the difference between the two loans. This increases leverage for the non-bank lender and can amplify returns, but can also increase risk as they would have to pay the bank back. Another mechanism that private credit uses is repo lines. These are typically larger than warehouse lines and are offered by the biggest investment banks on Wall Street, such as Deutsche Bank, Credit Suisse, and Goldman Sachs. Warehouse lines can allow for higher leverage on the collateral of loans. For example, instead of $600 million that was offered by the warehouse line, a repo line could offer $800 million. They also can have a lower rate than the warehouse lines. The disadvantage comes from the daily mark-to-market feature of repo lines. Wall Street investment banks have a trading desk for loans, and if there was a sudden drop in the value paid for a loan, the bank can call for that loan to be paid back in full with very little notice. Further complicating this is the fact that many of these loans are not publicly traded, so investment banks are the only ones who have access to the market rate for loans. A sudden change in economic conditions or outlook can therefore trigger a loss of these loans in the market and cause very steep losses for the non-bank lender. The last method we will be talking about today is securitization. Securitization involves pooling a bunch of loans together. After they are combined in one pool, they are separated into different pies called tranches. Each tranche is then given a rating by a bond rating agency. The tranches that are paid first have less risk and have less of an interest rate than the tranches who are paid after. After being rated, the tranches are then sold to investors. Non-bank lenders like this because the tranches each have a fixed rate. Regardless of what happens to interest rates, their liability to bondholders stays the same as the rate that was in the contract. Investors like this because they have a predictable and rated bond that pays them a fixed amount and is rated by a third-party agency. One disadvantage of securitization is that the legal and other fees associated with setting them up can be extremely expensive. $1 million of fees is not uncommon for a $100 million securitization, for example. Okay, now that we have an idea of how private credit works, let's talk about some of the risk involved. It should be noted that the private credit market has yet to experience a recession, so the results of an economic downturn are unclear. What we can say is private credit is becoming increasingly popular and relied upon in the credit market. Banks themselves are increasing their exposure to private credit. Remember those regulations that made it harder for them to lend? They are starting to offset some loans on their books by using private credit in a synthetic risk transfer. Like many parts of private credit, these lack the same level of transparency that the traditional bank sector has to follow, leading to uncertainty about the broader implications. There is an overall lack of regulation in private credit, and this can be good or bad depending on who you ask. It can be bad for risky behavior and over-leveraging the economy, although some may argue that private credit has only become a trend due to increased regulation of the banking sector. The increased demand for private credit may lead to more funds chasing after the same loan. This may lead to an asset bubble. Overvaluations can become increasingly dangerous for private credit because a default will lead to increased losses. Any losses will be felt throughout the entire system. What will happen to private credit in the next recession? The short answer is we really don't know. What we do know is that private credit is becoming an increasingly popular form of investment and credit solution for our economy. It's filling in a void left by banks after 2008. Investors and companies alike continue to favor it over traditional financing. Even banks are becoming more intermingled with private credit. It is expected to grow to over a $2 trillion industry in the next couple of years and employs some very unique financing structures. Whether good or bad, we are likely to see more about private credit in the future. All right, that's all I have, guys. Thanks for watching. Let me know what you think in the comments below, and see you next time.